I now want to know whether you've got a toaster in your house that was given to you by a bank. I have not heard that banks used to give up toasters. Hello and welcome to In Control, where we learn about the finance of everything. I'm Tash, your host, and I'm also the CEO and founder of Cable, which supports the show. I've not previously made big, bold predictions about an industry, but something I've been talking a lot about over the last few months is bank M&A, or the buying and merging of banks. I predict that we're about to see a lot more bank M&A for three main reasons. Firstly, when the stock market is up, there is generally more M&A. Public banks will have more money, more buying power, and acquisition targets will seem a lot cheaper. Secondly, the current administration is much less concerned about competitive behaviours than previous administrations. And thirdly, I think that the usual economies of scale that can be generated through M&A will be massively increased because of AI. The reason I think this is interesting to talk about is because everyone needs a bank in order to function in the world. It's super hard to have a job, to rent an apartment, or to receive welfare payments if you don't have a bank account. Banks are this sort of constant presumed service in our lives that most people have very little control over. Most people have very little control over which banks they use, what fees they pay, and what services they can receive. And when companies merge, it usually means less competition and higher prices. For banks specifically, it can also mean the closing down of branches that might be a customer's only access point to their bank. So I worry that more bank M&A could be quite detrimental to small businesses and regular people just trying to live their lives. In order to understand why banks merge and what the financial impact is on all the players involved, including you and I'm going to be learning from Joe Mancini. Joe is one of my absolute favorite people in banking and also a pro on bank M&A. He was the vice president of fraud prevention at East Boston Savings Bank when the bank acquired Mount Washington Bank. He was the Chief Information Security Officer at Radius Bank when it was acquired by Lending Club Bank, and most recently, he was Chief Operating Officer at BankProv when it was acquired by Needham Bank. So, Joe, thanks for being here to teach me all about bank M&A, and I want to start with what makes a bank a good acquisition target? You've been at banks that have been acquired or acquired. What were the commonalities that made them such good targets?
Yeah, first and foremost, thank you for having me on, Tasha. Always a pleasure to connect with you, especially on an important topic like mergers and acquisitions here. I think of mergers and acquisitions kind of in three steps, and there's a lot of different reasons why things could happen, but many times it just falls into one of these three buckets about what makes a bank attractive to be acquired or what makes a bank want to actually acquire. And so think of scale. Okay, you mentioned something like economies of scale. When we consider spreading fixed costs across more assets and what it could mean for, a larger bank or a smaller bank to just either merge and be able to spread some of those assets across that balance sheet, it makes it a lot more of a, process where it actually makes sense. Survival is another one. Okay, the industry is moving very quickly. A lot of competitors in the fintech space, a lot of competitors in these other markets. Consumer behavior is changing pretty significantly where it's not anymore this loyalty game, unfortunately, unless you're a major brand like Apple. Banking is losing that loyalty brand. So pressure from regulation, you're talking about tech expectations, deposit competition, that's the survival piece. And I would say the last piece of it for me would be strategy. It's around banks trying to grow into new markets, capabilities growing in a faster scale. So, you combine those three and you look at where the market goes, and that's what makes a bank attractive. And especially in a market like ours. And as you mentioned, I've been through a few of these. And this is in particular in the New England area, there's just not a lot of banks up, that are in a position to acquire. And so, you have a lot of mutual banks and a lot of mergers of equals. So it's a very difficult opportunity sometimes, but when it does happen, that's when you want to take advantage of it. And it usually falls into one of those three areas.
That's really interesting. Why don't we start with the first of those then, like scale? When I talk to a lot of banks that are sub 10 billion, there's a lot of some banks are like, we never want to hit 10 billion. Some banks are like, we're going to acquire beyond 10 billion. Talk to me a little bit. Help me understand why that matters and what that 10 billion mark really does for banks.
I mean, the 10 billion mark is critical, right? Because when you get to that point, I would say two big things happen. you start the interchange caps with the Durbin Amendment becomes a factor. Okay, so you start losing opportunities from revenue from the Durbin Amendment change. The other part of it is expenses significantly increase on the regulatory side, more oversight, more cost, more sophistication. I would say it's like going from high school sports to Division One in many ways, right? So a lot of times things get faster, they get tougher and more expensive. So if I'm a bank teetering on that 10 million in asset size, many times you're trying to just shoot right over that, leapfrog it to be able to scale it in a way where, you can absorb that hit from that cost.
I applaud you. It took you, I think, less than 5 minutes to bring in sports to our conversation. So well done for that, Joe.
You knew that was coming.
I did. Let's dig on that. You say it's often more attractive for a bank to leapfrog 10 billion rather than like slow crawl it. I don't understand why that would be beneficial. Really help me understand that.
Yeah. So as you mentioned, some banks try to avoid it at all costs. So they might linger around that sub 10 billion mark, which is hard to manage because you do grow over time unless you scale your strategy a little bit differently. But again, I think the cost that comes with that $10 billion growth, that asset size, you talk to any bank out there that has been at that level, that cost, it's going to end up surpassing that process where it makes sense to just sit at 10 billion. So a lot of these banks shoot to that 15 billion dollar mark so they can expand that revenue source to be able to, in a growth, to be able to absorb some of that cost. And that's really just what it comes down to. And again, I go back to the regulatory pressure. There's a lot more pressure at that point because at that point, you're a larger bank. You cross over that $10 billion asset mark, and it becomes a much stickier process where typically in that community sense, you're touching many other areas. So your stability is much more important to the communities you serve as well.
So because of the increased costs involved with being a bank that is bigger than 10 billion in assets, and because of the reduction in revenue from the Durbin change at 10 billion, there's actually no point being a bank of like 10.1 billion because you're going to be making less money than if you were a bank of 9.9. And so you really have to get to that 12 or that 15 to make it worthwhile.
Exactly.
So when you then think about bank acquisitions, and maybe related to the acquisitions that you've been a part of, were those acquisitions to jump over that 10 billion mark, or were they a merge of equals? Talk us through some like real examples of the benefits of the acquisitions that you've been through.
Yeah, in many ways. So going back to my East Boston Savings Bank one, which was 15 years ago around, which is crazy. It's really market expansion. I think in that time, banking was certainly different. The digital aspect of banking wasn't so expansive at that time. So it was really about who has the most brick and mortar out there, right? In that moment. So for us, it was about expanding our market footprint, our physical footprint in these markets that otherwise it would be expensive to have to go and build every single branch that you might be acquiring. And you acquire the clients and you acquire the loan portfolios as part of that. So that was certainly part of it. Fast forward to Radius, when we were the first bank to have been acquired by Fintech, when Lending Club acquired Radius Bank, that was done because you have a much different environment. You had a Fintech that had an option of whether or not they actually go and try to get an actual bank charter on their own, or is it more cost effective, cost efficient to acquire a bank? And in this case, the culture is matched pretty perfectly, where Radius was very much a tech forward bank and digital focused bank. It aligned perfectly with what Lending Club was trying to do. And then you blend that area. So, the tech focus, in that sense, there is no physical footprint. It's technology, it's bank charter, it's the portfolio that comes with it, and a deposit base. In this case, most recently with BankProv, it was a mixture of all of that, I would say. You have a bank like Needham who is very much looking to grow. They were able to acquire us in a really strong market in that region that we served, but also on our technology aspect that we did a lot of development that they found very much attractive and are able to implement and then therefore apply to their client base. So it's a mixture of things, and it's actually very interesting to see how things have changed over that last 15, 20-year cycle.
Yeah, that's interesting. You mentioned the first one at East Boston Savings Bank. The branches. That was really interesting. You wanted branches. You didn't want to have to go find the buildings, get those set up. You just wanted to be able to jump in with those, the customer bases set up with those branches already there. Is that still a factor? How do banks, especially, community banks, local banks, how do they think about the value of branches today?
It still serves a purpose for certain segments of customers. I think maybe some interaction, people still many times want that face-to-face interaction, right? So especially if there's fraud or if there's something you're trying to do that's more critical to your life, of a loan or something like that, many people still want that face-to-face interaction. What's changed as part of that, though, is the digital experience within those branches. And I would say that more often times than not, the experience, especially the last 5 years, was still very much paper driven, right? You're still signing papers, you still have 100 documents you have to initial, whereas now the branches are getting smarter and these banks are able to retain that same experience in that digital sense in their branches. So I think there's still a segment of customers or consumers that want that experience. But when I look back at, my 18-year-old son, my 12-year-old daughter, they're never going to go to a branch. So that's slowly going to phase out, and that experience would be much more driven for a different purpose. And I think it's more, again, service needed versus a desire to actually go to a branch and have to do something there.
I have this idea of you acquiring a bank and walking into the bank's branches and like unlocking the safe and seeing if all the gold bars are stacked up where they should be. What kind of branch inspections happen? How does that work?
Oh, it's an interesting process. I mean, that when I was at East Boston, we acquired and or built probably another 20, 30 branches in that time.
Oh, wow.
And so going through that process, it becomes a pretty cookie cutter after a certain number of times because you know what you're looking for, you know what you're going to be doing. It's a pretty replicative process. And so I think in that situation, when you go, it's really about location. It's really about what comes with that location. Does it fit into your strategy as a whole? Because there's nothing worse than acquiring a branch and nothing happens, right? The customers leave. There's really not much traffic there. And again, the two main pieces of that are deposit acquisition or retention and loan portfolio retention. Those are two big factors as part of it. So when you go through that process, it's very much about understanding the foot traffic in the area. It's understanding the markets it serves. Is it more commercial? Is it more consumer focused? So there's a lot that goes into it. Obviously cost, how much is it, how much is this acquisition or how much is acquiring a branch going to cost us? And does it make sense for what we're going to get from that? So there's a lot of factors. I will say back in the day on the security side, that was always an important part of it. We always knew we would change things. It wasn't a big deal, but location, and I will tell you a very quick story. One of our locations back in the day was on one of the busiest streets in a city near Boston, and was hit very often with bank robberies. So of course we opened the branch there, and we were hit with a number of bank robberies in the first month. So we had to go then and adapt to that and add some additional fencing and all these things that had to come with it. But I think that pre-work is so critical, understanding not just the market factor, but it's crime, it's all these other factors as well.
Yeah. Wow. Interesting. I have no idea how much it would cost to secure a branch in that way, but also make it look appealing and have customers walk in off the street. But that's an interesting problem to solve. Yeah.
It's a balance.
So sticking on the scale as the sort of the first reason why bank M&As might happen, economies of scale, like when you go to business school or if you're studying economics anywhere, you always learn that economies of scale are really why M&A or any kind of acquisition might happen. Can you talk me through the main economies of scale that an acquiring bank will be looking to achieve when they pick up a smaller bank? Where are those different economies of scale? Can they be bucketed into, the people, the tech? What are they?
I think more recently it's been two big factors, and it's compliance costs. You have to take on more risk as a bank, for the most part, to remain competitive. So compliance costs have gone up, whether it's people, technology, anything to support that, especially if you're opening the doors to a more national digital approach. Fraud is a big factor. I would say technology expectations is another. When you have so many options out there to use for financial purposes, and the fact that most consumers have anywhere from 9 to 12 financial related apps on their phone. And that's even including things like Walmart and Starbucks, where you keep money. And so I think, the technology factor of it with the mobile apps and faster payments and fraud tools, all that aspect of it has become so expensive to maintain and compete with that again is another factor.
Is it the case, like touching on that technology point, that when you merge two banks or when a bank acquires another bank, that you just choose one of the core banking systems, for example, and you move all the customers to the one core, and then you can immediately save on the bank's biggest technology cost? Is that what happens?
That's a factor. I mean, in our case recently with BankProv and Needham, we just happen to be in both in the same core. So that certainly helps. but that certainly isn't the case many times. And so you look at things like how long is the contract, right? What is the termination fee if we term this contract? Which is the better tech? Which is the better experience? The core is probably the biggest part of it, typically the most expensive part of the bank in terms of the technology side. So, and you have to think about this as well. Doing a full core conversion is a disruption to clients. And so you want to minimize that as much as possible. So all these factors are considered. It's a major decision, and that's just one small element of the entire process.
Yeah. How long can it usually take from the technology perspective, from when the acquisition or the merger is finalized to the technology strategy being fully realized, all of the integrations complete, or the closing down of other vendors that you don't want anymore?
I would say, speaking for this last acquisition we just went through, it was going on real time. So at the time of close, our conversion happened the following weekend.
Wow.
So we closed on Friday. The conversion started at 4 p.m. that Friday. So that weekend, that Monday morning, that next Monday, the customers of both banks were now customers of Needham Bank. So it can happen at real time. Most of the time it happens, especially with the regulatory environment, post close. So you have the plans in place. You go through vendors and you go through duplicate vendors and who we picking, who we terminating. You have the decisions on core. You have all those major decisions ready to go. And typically you might start once that close is done. So usually in that case, it could take anywhere from, a couple months to a year, 18 months, depending on what you're actually doing. And again, the goal is to minimize disruption for employees and for customers as well.
Yeah. Okay. Very interesting. It sounds like a well-oiled machine by the time of your third M&A then. So my last question, I guess, on this tech point is AI. And you have a lot of technology background, Joe. Do you think AI is going to impact M&A at all? Do you think it will trigger more M&A? Do you think it will help with any of this technology integration and transformation?
Not anytime soon. I do think where it can help is certainly more so on the investment banker side, right? As they're deciding, they're running numbers. There's no question about that. Their job can get more efficient with this. But once AI has developed a little bit more, for example, on our end, we had implemented over 900 different automations. We were very much on the line with AI in terms of implementing different variations of it throughout the organization prior to being acquired. And so do I think that it'll help? I think it will at the right time. I just think it's still too early to make an impact right now. But we're seeing impacts of AI across customer experience in the call center, online, and things like that, operationally throughout the organization. So it's chipping away little bits and pieces of it, but it's still going to take time for sure. And I don't think it's anything that's going to really impact it for at least another probably 3 to 5 years realistically.
Yeah. With so much talk about how AI is going to completely disrupt every sort of computer-based job in the next handful of years, it's really hard to align that with just, the speed at which banks move and how a lot of this stuff just takes so long.
Yeah, Tosh, that's a great point. And I will say this, take a look at the Industrial Revolution timeline. Someone pointed this out to me about 2 months ago. And when you look at the first few and, the first couple in particular, it went over 100 years for technology to really progress. So where we are today, between the fourth and now the fifth, within 10 years. And so when you're historically in an industry which is extremely slow to react to technology and adopt changes like that, I've said this out there before, banking is in an identity crisis mode right now because you don't know what direction to take things in terms of how quickly you need to move. And it's happening quickly. M&A is going to be a big factor in these decisions. And so again, costs and all these other things we touched upon will be a big factor, but there's no question about it. I think that's where it's going to be. The speed of technology is moving very quickly. And when you're up against an industry that is just historically slow to adopt, that's a tough combination.
Yeah, for sure, for sure. Sticking on the economies of scale, one of the things that I'd love to hear your thoughts on and learn a little bit about is the people side of things. Because again, with like a typical M&A, there are headcount reductions to benefit from those economies of scale. Do you need 2 BSA officers? Do you need 2 chief compliance officers? No, you don't. How does the people side of this work? How do those assessments happen? And what type of headcount reduction do you usually see? Can you put a percentage on it in terms of the acquired company?
It's the most delicate part. There's no question because you're impacting people's day-to-day lives, sometimes positively, sometimes negatively as part of it. And it's never a fun part of the process. we've been pretty fortunate in each of my acquisitions that my first one, we got rid of nobody in that situation. So we acquired an entire bank, kept everybody there as part of it. And the others were very similar, right? So this most recent one, I would say we had some redundancies that I think were part of the process. But however, in this situation, I would say from a percentage standpoint, it really depends on the expense because that's baked into the cost. So as you're going through the discussion on what the pricing of the deal is going to be, the retention of employees and what those costs are a factor of that. And so you might bake in a 30% retention, right? So what we've done is you bake that in as part of the number, but once you actually start going through, pull the covers back a bit and see who's actually there, what sort of technology you want to keep, what sort of operational factors, whatever it might be, sometimes that changes. And it has over my last couple, my most recent one, where, you start seeing the talent that's there. And that's a whole other topic as well as the gap in talent, especially in this industry. You want to retain that talent. So that's the best way to do it. So I would say, from percentage perspective, I've seen it anywhere from 30% retention up to 75, up to 100% in many ways. But I've also seen where banks have only kept lenders or branch folks and that, 5 to 10%. So it really ranges on the strategy of that acquiring bank, but it could range in various ways.
Okay. It's interesting. And this is one of the things that as we think about, are there going to be a lot more M&A? We're living in this time where everyone is worried about AI taking over all the jobs, and everyone's going to be living off a universal basic income in 3 years' time because there'll be no jobs left. It sounds like when banks are acquired or they merge, there oftentimes is, a reduction in headforce. Why do you think we're seeing more bank M&A right now, Joe? I mean, I gave some reasons that I thought we might see more. But also, if we are seeing more, and if we're going to see more in 2026, how do you think we can deal with as a society that this loss of employment for some of these bankers? Where are those people going to go? How do we solve that problem?
It's the $1 million question, I would say. And the challenge becomes, again, it's an industry-wide problem. It's the lack of adoption, the speed of which we're adopting technology. And we have to compete with fintechs. You've got to compete with other factors out there that are moving much quicker. To attract talent at a bank, it's very difficult, especially when you're talking about certain areas where you're competing with some unicorns out there that are, offering beer taps in the lunchroom. I think that the challenge becomes a strategic decision. So when you're looking at development and things like this, how do you attract the right talent to get you into that position to compete with these other fintechs and these other banks, and especially the larger banks that have these budgets to be able to do this? So to me, that's the biggest factor. I think it becomes that. The other part of it is, I would say, beyond the people, as we've talked about before, it's succession planning, it's stuff like that. But it's also, again, some of these banks just don't know what else or don't know how else to expand on that. So, and what I mean by that is, again, you're coming up with factors of expenses over compliance, of technology, looking down the road on that. And from a budgeting perspective, it becomes very difficult to see that and say, okay, look, we're competing against the top 5 banks that retain 40% of market share on deposits. We've got competition against the fintechs that retain another 40+%. That leaves, I saw a number on 17% of deposits for banks and credit unions. So combined, over 8,300 institutions to fight over that deposit market share. That's hard to do. Sure, you could throw a rate out there, but that's not going to really keep people. It's going to be the convenience. It's going to be the frictionless experience. It's going to be factors that help you compete with what consumers want today. And that behavior is a big part of it.
That's interesting. That sort of leads my mind towards, banking as a service. And yes, these fintechs might have a lot of these deposits, but those fintechs have got to be working with a bank, and those deposits ultimately held with a bank. And we are, of all of the banks in America, the 4,500 or however many of them there are, only a very small number of those are actually in the banking as a service game right now, where they help those fintechs hold deposits. So are you seeing, or do you think that we're going to see some M&A whereby the banks that have entered into the banking as a service space become very, very attractive because they have all of those relationships with those deposit gatherers, essentially?
100%. I think the way I see the future in banking is going to be embedded finance. These everyday businesses that people interact with that offer financial solutions, that to me is the future of how things are going to interact, and banking is significantly going to change because of that. The one factor that's missing though as part of that is trust. And that's where the banks still have that trust factor. I think that is a differentiator. It's slowly declining, right? It's slowly decreasing because, again, I use Apple Pay all the time. I trust Apple. So, but to your point, the 150-ish, maybe 200 banks that are actually actively in the banking as a service space, that's a very small portion of the entire industry. And so if you're looking to acquire, especially if you're a fintech or another larger bank, you know where the future of banking is going. So you're going to start looking at things a little bit differently. Again, I will say this though, loan portfolios and deposit acquisition are still the biggest reasons you're acquiring another company for the most part in banking. Because again, to go and attract a new depositor or to go and gain a new lending relationship is difficult. If you can acquire a portfolio or a group of that, it just becomes more cost effective.
Yeah, and that makes me think about in the UK, there is what's called an electronic money institution license or an EMI license, which like a fintech might get, and it gives consumers trust because they're regulated by the regulators that also regulate banks. But the caveat is that those institutions cannot lend. They have to keep the dollars one-to-one in a regulated bank, and they cannot lend out that money, which of course is how banks mostly make their own money, is by lending out the deposits that they have. It'll be interesting. There's been a bit of chatter around, will there be like a new fintech license here in the US? That might fundamentally change that trust question, which you just posed as sort of the main differentiation here. It'll be interesting to see how the regulators implement that kind of fintech license and whether it will look anything like the UK version.
I think that has to be one of the biggest points. Again, when you look at the general consumer today and the trust factor within banking, it comes with the FDIC insurance. It comes with these things that have protection behind it, where you still have the competitive edge against a fintech or some other institution out there that's a non-bank institution. Will that matter though in 10 years, 15 years? Again, the days of banks giving out toasters and microwaves to keep people there, it's just not what it is anymore, right? So again, my son who's 18, all he cares about is that he can go use his card for gas or he can go send his friend money. That's all he wants. And that's generally the consensus for most people today. So that generation expectation is going to be there. So again, will fintechs eventually have, I feel like we've been hearing about this for at least 10 years now. And I hope so at some point, but there needs to be some regulation on the fintech side. But again, I think the banks, those smarter banks, are going to understand what it takes to actually compete with fintechs, and you work with them. Like, you have to combine that. It's not necessarily you're fighting fintechs. It's you're combining it, you're working together and offering this embedded finance solution that I think, again, will be the future of finance. No question about it.
Yeah. I now want to know whether you've got a toaster in your house that was given to you by a bank. I have not heard that banks used to give out toasters.
Oh man, I have oven mitts. I'm sure I could pull something out of my office from the other banks I've been at that just, the swag that was given out. Oh, that was a big thing. The toaster ovens. My mother was in banking as well. So I remember when she worked at what was then Shawmut Bank, which became Fleet Bank, which became Bank of America in this Boston area. She would take home a toaster or something for opening up a CD, which at the time the rate was at, 15% for a CD. So, banking's changed quite a bit. There's no question about that.
I'm so pleased that you mentioned toaster oven specifically, because like most English people, I have absolutely no idea what you mean. Toaster ovens are bizarre.
I'm with you. I very rarely use it. It makes no sense to me. I just, whatever. I'll take it if it's free though, I guess.
Yeah. All right. Okay. Yeah. Very interesting. I always thought that Snapchat should have started a bank, because all the kids were Snapchatting away. And if they could have grabbed that market and then scaled that through their sort of teenage and early adult years, that would have been just a brilliant acquisition path for them.
Gosh, look at Mr. Beast. He's starting a bank, or he's applied for a financial license. And so, that's exactly the way it's going to go. I mean, TikTok and Snapchat and Instagram, they're going to offer these embedded solutions to be able to basically bank with them. And that's just what it's going to be. And that's why, again, I think the role that banks will play in the future will be that embedded finance role, because, the days of going to a branch is going to be long and gone in the next 15 years. For sure. And so that to me is what it's going to be. The expectation is going to be fast, frictionless, protection and all that stuff that's there, the trust factor in many ways. But yeah, it's going to be fun to watch. I'll tell you that much.
Yeah. And it does make you really pretty worried for the hundreds or thousands of banks that are in tiny towns, that are purely paper-based, because to support a fintech, and therefore with your thesis at least, to be able to survive, you're going to be able to have to support the technology, because these fintechs will be onboarding customers remotely. You'll need to be able to communicate with these fintechs and all of their employees remotely. And in a lot of banks, that's just not done. It's still paper-based applications, paper-based processing, and everybody is literally in a branch. Which makes me maybe we can now talk about one of the worries I have with all of this, which is how will a lot of the world actually get the products and services that they need? I have this, horrible image of a small business owner. Maybe you're a farmer, maybe you're a plumber, maybe you're a shop owner in a small town in America, and you need a new loan, you need a mortgage, you need to be able to buy a piece of equipment. And you walk down Main Street and there is not a bank there for you to walk into. How are those people, how are those small businesses going to be able to survive this?
There still will be so many options for them. And I think the smarter companies out there will drive this by data. So there'll almost be a predictive aspect of this where you have the data of what that business is going through, let's say. So for most situations, let's say, you see this company interacting with a producer or whatever it may be, you're then going to be able to take that data and offer them a personalized product based on what you're seeing in data. Well, let's take a consumer example, okay? I'm going in for repairs. You see that there's transactions on my account. And over the last 2 months, I've had issues with my car. You can kind of gather that based on the data. Wouldn't it be a great time to offer me a new car loan at that point in that situation, real time? And so you're almost getting to that point where that issue becomes more predictive. And that's where AI can help. That's where I see that being the case. Will a business ever run out of options on how to get a loan? No, absolutely not. Will it change in how they're going to do it? Yes, for sure. But I think if anything, it's going to be a faster one-click solution at that point, because again, the banks that are smarter at that point, or the ones that are embedded in companies, are going to be offering that in a one-click solution, make it a much easier process than it will ever have been in the past. Credit's going to change because of AI. All these other factors will change because of AI. That'll happen. There's no question. And I'm already talking to some banks that are out there embedding AI in their credit decisioning, credit analysis, and it's still very early, but it's going to move quick. There's no question about that.
Yeah, I guess when lending is the way that banks make the most money, they will always find a way to make sure they get those loans to the people that need them.
Yeah, well, again, you mentioned, and no question about that. Yes, today, traditionally, loans are what drives the revenue in a bank. But when we look at how digital assets and tokenized assets start playing a role into this, stable coins, and now it's not necessarily directly tied to lending, but there are going to be ways where payment companies and payments become a big factor here as well. And so that revenue source, although today might change, might look a little bit different today and certainly lean towards that lending side of it. I think we're going to start seeing more bundling of services out there where, for a business, there's more predictable cash flow. There's more ability to manage cash management, treasury management, all that stuff baked in. So actually they'll have more money and flexibility in their pockets than they ever have before. I think that's going to happen. That has to happen. But, I do think, at some point it's going to, and again, this is not going to happen overnight. This will take time. Companies will adapt. Banks will adapt. Fintechs will adapt over time. But it's going to change. There's no question about it. And the revenue will come with that as well.
Yeah. Okay. I like your optimism, Joe. I feel like you're a bit more optimistic about this than me. I have two questions then, which are definitely from the pessimist's viewpoint, which maybe you can completely debunk for me. Is it the case that whenever there is bank M&A, fees increase?
No, I don't think so. I mean, again, because I can't say that's the case for every single one. The fee part is interesting, though. Again, banking traditionally, yes, you would get docked for overdraw on your account. You would get docked for your check was kicked back. Traditionally, that was what a fee-driven industry we were. We would do fee assessments every 2-3 years to make sure we were in line with our competitors. That was just a thing. When you have neobanks out there that are charging no fees and those consumers get used to that aspect of it, to your point earlier, it becomes much more difficult to be a profitable company if you're not thinking about this the right way. And so again, today the banks still have lending to lean on, but I do think that's going to change, and I really think that's going to be a big aspect of it for sure.
Interesting. And I was recently speaking to the folks at Vantage Bank who are getting into tokenized deposits, and they are they're seeing a single wire go from something like $7 down to $1, which is just unbelievable. So if banks can also save that much on costs, then they don't need to be increasing those fees.
Again, that's exactly my point. There is a first mover advantage to this as well. So the banks that start getting into this and finding the solutions to do this can make some money, especially in the first few years of this, because again, it's still going to take time for the adoption of this. It's still going to take time for the regulators to feel comfortable and understand how to, manage this risk. So I do think that that's one aspect of it. But yeah, it's going to, again, there is a first mover aspect of this that I think that the banks that will take advantage of it and are able to deploy this as a product will have some major opportunities for sure.
Yeah. Okay. And then the second worry I have is every bank has their own risk appetite. They have decided what types of customers they're happy to serve with a merger or an acquisition. Do you ever see the acquiring bank debanking any of the customers that are outside of their risk appetite? Does that happen very often?
Yeah, it does. It does. And again, I think that going back to your question about the BaaS banks being acquired or the embedded finance banks being acquired, the risk appetite is a big factor. Again, it really depends on the strategy of the acquiring bank. If their plan is to grow quickly and, acquire as many locations, acquire as many deposits and loans, and that's all they want, they're going to cut out the noise. They don't want to deal with the regulatory noise. They don't want to deal with the pushback from the regulators. But again, I think in this situation, it's a consideration as part of the discussion. When you meet with those banks as part of this, and you have those dating sessions, I would call them, in the beginning part, and you go, it might be the CEOs in the beginning, it might be the CFO, the COO as part of this. There's very few people involved in this process in the beginning until it really gets expanded. That to me is the biggest factor. That's when you determine cultural alignment. You determine what your goals are as part of this and what are you looking to do, and is this a fit? Because we had plenty of conversations and it just wasn't a fit, and that's okay. But that's all part of the discussion that you want to figure out now, because again, I think the last thing you want to do is get to the finish line. And I've seen plenty of deals out there that you signed your LOI, and then you get to a point where that process for the regulatory approval piece of it, or you get to the agreement part of it, and it falls apart because there's misalignment on culture, there's misalignment on the future of the company. So those are all factors you need to nail down early in the process. No question about it.
Yeah. Okay. To wrap this up, Joe, tell me, do you think we're going to see a lot more M&A next year? And give me a number. How many are we going to see?
Yes, I no question about it, especially with this administration. I think, to very quickly put it in perspective, our deal is approved in basically 3 months. And so I think if that's going to maintain, there's going to be a lot more appetite. And if the markets, if there's enough capital still out there, you have that combination of strong capital and a regulatory regime that is willing to move things along, no question about it. I think in the next year, we've already started seeing, especially in the last month, some big announcements in this space. And so I would say for the next year, that's going to continue. And I'll make a bold prediction: in the next 10 years, we'll be down to probably 2,500 banks out there.
Oh, wow. So that's basically a 50% reduction.
Yeah, no question. That's where I see it.
Oh, wow. Okay, that's huge. And I guess if you were being given a blank check right now and you could go and acquire any bank out there, which is the one that you would buy?
Well, can I start my own bank? Because is that a question I get to?
Okay, so absolutely. That's a great question, though. Why would you start your own bank rather than go buy one with an existing deposit base?
Well, if I had the option, I would buy an existing bank with a charter, okay? But I would rip out the plumbing. I would recalibrate the entire thing, especially if it's a traditional vanilla bank. To me, again, the goal there would be ultimately to position that bank for the future of finance, the future of banking. So if I had the opportunity, I would most certainly acquire a bank first to get that a charter, because that's a saver of money and time for that process. If that wasn't an option, you go the de novo route and, you start that bank, you build that bank from the ground up. That also removes a lot of the friction. You're not dealing with legacy systems. You're not dealing with, legacy culture. You get to build it for yourself. Not as simple as just saying it, but it's all part of the consideration. So is the cost of saving yourself the time from having to, apply for a new charter worth it more to you than potentially, acquiring a bank and, having to rebuild the culture, rebuild the plumbing. So it's a fun game to think about, but those are two big decisions. But, I think as far as buying a bank out there today, how can you go wrong with JP Morgan? I mean, they dominate the world. I mean, it's just, it's just one of those major banks that's doing everything they need to be doing, even though it's being done quietly sometimes with Jamie Dimon. But it's interesting to see, no doubt.
Yeah, when I said blank check, I guess I was giving you the option to say JP Morgan.
You said blank check. I'm going to take the big one.
I did, of course. All right, then I guess my final question is, give me a sense of the regulators in this. So does it matter if the bank that you're acquiring or merging with is regulated by a different regulator? Are there better or worse regulators to be buying into or to be merging with? How do you think about that?
It doesn't matter, I guess, in the grand scheme of it, because again, many of the deals I've been involved in, it's been different regulators on each side. It may delay the process a little bit because you have to get the approval on one side or the other. It's really the acquiring bank that needs to approve it. But also, again, you need the regulator on the acquiree side to do the same. So I would say that there's no one better in these situations. They have gotten much better at the ground level at this as part of this. So I would say, let's take it back to just a regulatory exam or safety and soundness exam compared to maybe a year and a half to 2 years ago versus today, the tone has changed in DC, right? So, you have the ground regulators of the folks in the branches, the folks in the buildings virtually that are assessing the safety and soundness of the organization. You have them in there. And I think the change is that there's a little bit more reluctance on their part to bypass things. Meaning they're more reluctant to let something go because of potentially something coming back on them, as we've seen over the last few years of the ups and downs and sometimes the regulatory space. So when it gets out to the regional or the DC office, that's when you see it change. I think that they're much more open-minded and more willing to kind of let something go for the most part. So that's been the most interesting change, no doubt about that. But it's a challenge. And they're doing the best they can. They're losing people. That's why I think the bank M&A space is going to be so hot, because the regulators want this to decrease. They don't have the people to support this over time. They're losing talent on their end, and it's a losing battle on their side. So manage the risk, reduce the number of banks, and unfortunately, that's just the way it's going to go.
I had not looked at it from that point of view, but of course, I mean, there's this drive to reduce the number of the staff at these regulators, and that's how do you justify that? Well, if there are less banks to regulate, then you don't need as many. Yeah, of course.
Yeah, for sure.
Yeah. All right, Joe, this was awesome. Thank you for joining me on In Control. And as always, it was just a delight to chat with you. Thank you so much.
Till next time.
Yeah.